Ethereum isn't what you think anymore, the hidden agenda. Ethereum was supposed to be the future. When it launched in 2015, Ethereum wasn't just another cryptocurrency. It was a vision, a decentralized world computer, a network where code is law, and where power wouldn't belong to banks, governments, or corporations. The dream was bold: smart contracts, DAOs. A new internet economy, open, trustless, and free from middlemen. But something changed. Today, Ethereum is no longer the grassroots movement it once was. It's faster, more scalable, and more institutional friendly. On the surface, it seems like progress. Underneath, however, a silent transformation has taken place, one that most investors and users aren't even aware of. The shift from Ethereum 1.0 to Ethereum 2.0, the rise of staking dominance, and the quiet infiltration of centralized entities have altered the core values of the Ethereum ecosystem. This isn't the decentralized utopia we were promised. This is something else entirely. What if Ethereum is no longer neutral? What if it's being shaped, strategically, by those who stand to benefit the most from controlling the infrastructure of the next financial system? In this video, we're diving deep into what Ethereum has become, and what it may never be again. We'll explore its original ideals, the reality behind its recent changes, and the growing influence of shadow players who are quietly steering Ethereum's direction. Is this just natural evolution, or is there a hidden agenda driving Ethereum toward a future where decentralization is just a marketing term? Whether you hold ETH, build on Ethereum, or simply believe in the power of Web3, you need to understand what's really going on beneath the surface. Because this isn't just about Ethereum, it's about the future of digital freedom itself. Stay tuned. Chapter 1: The Original Vision, Ethereum's Promise of Decentralization. To understand what Ethereum has become, we first need to remember what it was meant to be. In 2013, a 19-year-old programmer named Vitalik Buterin published the Ethereum white paper. At the time, Bitcoin had already proven that decentralized money could work, but Vitalik wanted more. He envisioned a programmable blockchain, a platform that could run decentralized applications, automate agreements through smart contracts, and empower a new kind of internet. One not controlled by corporations or centralized authorities, but governed by code and consensus. Ethereum's launch in 2015 was electric. The community it attracted was radically idealistic. Developers, libertarians, open-source advocates, they weren't just here to get rich. They wanted to build a parallel economy that was borderless, transparent, and fundamentally different from the financial system that had failed so many during the 2008 crisis. In those early days, decentralization wasn't just a feature. It was the mission. The Ethereum network was designed to be run by anyone, anywhere. Anyone could spin up a node. Anyone could contribute to development. Anyone could propose ideas through Ethereum Improvement Proposals, EIPs. The foundation supported a bottom-up ecosystem where community consensus drove progress. The ETH token itself wasn't sold as a financial asset, but as gas to power this decentralized world. And the ambition didn't stop there. Through tools like smart contracts, DAOs, decentralized autonomous organizations, and permissionless finance, Ethereum promised to remove intermediaries from virtually every industry: banking, insurance, real estate, and even governance. For the first time, users could transact, invest, borrow, and organize without relying on any central authority. This was revolutionary. But it was also fragile. Even in its infancy, there were signs that Ethereum's decentralized dream could be vulnerable. In 2016, The infamous DAO hack exploited flaws in a smart contract and drained millions of dollars worth of ETH. The community was forced to make a choice: stick to the principle of code is law, or intervene and hard fork the chain to reverse the theft. They chose to intervene. While many saw it as a necessary compromise, it marked a philosophical turning point. Ethereum had shown that it could bend under pressure, that it wasn't as immutable or decentralized as promised. The original Ethereum continued as Ethereum, while the purists forked off into Ethereum Classic. Still, the ecosystem moved forward. ICOs exploded in 2017. DeFi blossomed in 2020. NFTs went mainstream in 2021. And yet, with every new wave of adoption, Ethereum became more exposed to the real-world forces it once sought to disrupt: regulation, scalability limitations, and most of all, centralization risks. It became clear that Ethereum couldn't scale to a global user base without fundamental changes. Gas fees spiked to unsustainable levels. Network congestion became a daily frustration. And with those problems came solutions, but not all of them aligned with the original vision. The Ethereum Foundation began pushing for Ethereum 2.0. A sweeping upgrade that would transition the network from proof of work to proof of stake. The stated goals were noble: faster transactions, lower fees, and greater energy efficiency. But the trade-offs were significant, and mostly hidden in plain sight. Proof of stake favors those who already hold large amounts of ETH. It concentrates influence. And the new staking model, while technically decentralized, introduced subtle forms of control through validator dominance and institutional players entering the scene. We'll get to that in the next chapter. For now, what matters is this: Ethereum was born as a counterbalance to centralized finance. It aimed to give power back to users, not to replace Wall Street with a different set of gatekeepers. But over time, as money poured in and complexity grew, that vision began to drift. Today, the question is no longer whether Ethereum can scale. It's whether it can scale without compromising the values that made it matter in the first place. Because once decentralization is lost, it's rarely regained. And if Ethereum is no longer decentralized, if it's quietly becoming just another backbone for institutional finance, then what exactly are we building? Chapter 2. The Merge and the Rise of Centralized Staking. On September 15, 2022, Ethereum changed forever. The event was called the Merge, a historic shift from proof of work, POW, to proof of stake, POS. It was hailed as a technological breakthrough, the most significant upgrade in blockchain history. After years of planning and delays, Ethereum finally merged its execution layer with the beacon chain, eliminating the energy-intensive mining process and replacing it with a system where validators stake ETH to secure the network. It was efficient, it was green, and it was celebrated. But underneath the applause, something fundamental changed. Ethereum's shift to proof of stake altered not only the mechanics of the network, but its power structure. In proof of work, mining required hardware, electricity, and distributed effort. Anyone with the right equipment and access to energy could compete for block rewards. It was flawed and resource-heavy, but it was open and relatively hard to centralize. Proof of stake, on the other hand, works differently. Validators are chosen to produce blocks based on how much ETH they stake. The more ETH you lock up, the more likely you are to be chosen. In theory, this sounds fair, aligning economic interest with network security. In practice, it leads to concentration. Here's why: staking requires 32 ETH to become a solo validator. At today's prices, That's well over $100,000. Most everyday users don't have that kind of capital. So they turn to staking pools, services that let users stake ETH together and share rewards. Convenient, right? But look at who runs these pools. Lido Finance, Coinbase, Binance, Kraken, just a handful of entities control a massive share of all staked ETH. As of 2025, over 60% of Ethereum's validator power is concentrated among the top 5 staking providers. Lido alone controls over 30%. That's not decentralization. That's oligopoly. What's worse is that many of these entities are subject to regulatory pressure. In 2022, the US Treasury sanctioned Tornado Cash, a privacy tool built on Ethereum. Shortly after, major staking providers began to censor transactions linked to Tornado Cash to comply with sanctions. This was a clear demonstration. Centralized validators could be compelled to act against the supposed neutrality of the network. The Ethereum community noticed, but the momentum of institutional staking didn't stop. Today, Ethereum's consensus layer depends heavily on actors who are regulated, corporate, and potentially vulnerable to government influence. These validators decide which transactions get included. And more importantly, which ones don't. This creates a scenario where Ethereum's infrastructure is no longer neutral, but selectively programmable, depending on legal and economic pressures. And then there's MEV, maximal extractable value. MEV refers to the ability of validators to reorder, include, or exclude transactions within a block to maximize profit. It's a sophisticated, shadowy practice that introduces incentives for front-running, sandwich attacks, and censorship. With the rise of staking, MEV has become even more lucrative and increasingly controlled by a few entities who dominate the block building process. The merge didn't fix these issues. In some ways, it made them more dangerous. Instead of distributed miners, we now have gatekeepers with economic leverage and regulatory exposure. The very system Ethereum was designed to escape, centralized financial control, is creeping back in through the back door of staking infrastructure. This isn't an accusation. It's a pattern. Ethereum's roadmap has emphasized scalability and adoption, but it has done so by making subtle trade-offs. Trade-offs that benefit large stakeholders, institutional players, and custodial platforms. The idea of solo staking is still technically possible, but in reality, the network now leans heavily on aggregated power. And that raises the real question. Can a network truly be decentralized if most of its validators can be pressured, regulated, or financially incentivized into uniform behavior? Vitalik Buterin himself has acknowledged these risks. In various blog posts, he's written about the dangers of staking centralization, suggesting possible protocol-level solutions. But so far, the economics continue to favor the biggest players. The merge was not the end of Ethereum's evolution. It was the beginning of a new phase, one where the technology works better, but the governance becomes murkier. For investors, this means more than just staking yields or faster transactions. It means Ethereum may no longer be the neutral, trustless platform it once claimed to be. It may now be a network governed not by code and community, but by capital and compliance. The question isn't whether Ethereum works. It's who it now works for. Chapter 3. The shadow players, who really controls Ethereum now? Ethereum was born as a decentralized alternative to traditional finance. But today, a growing number of critics are asking a troubling question. Has Ethereum become captured by the very forces it was meant to disrupt? To answer that, we have to examine who really holds power in the Ethereum ecosystem, not just technically, but economically and politically. Let's start with the Ethereum Foundation. Founded in 2014, the foundation was never meant to control Ethereum. Its role was to support development, fund public goods, and promote the ecosystem. But over time, the foundation has become one of the most influential voices in Ethereum's roadmap. While technically not a governing body, its opinions often steer protocol decisions, influence the core developer community, and signal direction to the wider market. This wouldn't be a problem if the foundation were truly independent. But it's not entirely clear who funds what. The foundation holds a sizable treasury of ETH, controls major grants, and works closely with major entities in the Ethereum ecosystem. Critics argue that it operates with limited transparency, and although Vitalik Buterin has distanced himself from central control, his influence remains substantial. His public blog posts often act as philosophical guidance for where Ethereum is heading. When Vitalik speaks, the market listens, and developers follow. But the foundation is just the beginning. Over the last few years, institutional players have quietly moved into Ethereum's core infrastructure. These include centralized exchanges, venture capital firms, staking as a service providers, and infrastructure companies. Take Coinbase, for example. It's not just a place to buy and sell ETH. It runs validators. It participates in governance. It lobbies regulators. The same goes for Kraken, Binance, and others. These platforms have millions of users who unknowingly delegate their ETH to them for staking rewards. That ETH gives these entities significant say over Ethereum's consensus and economic incentives. Then there's Lido Finance, a seemingly decentralized staking protocol that has become one of the most powerful entities in Ethereum. Lido allows users to stake ETH in exchange for a liquid token, stETH, which can be traded or used in DeFi. But while the protocol is technically open source, its validator set is curated by the Lido DAO, which itself is heavily influenced by a small group of participants. As of early 2025, Lido controls over 30% of all staked ETH, enough to significantly influence consensus and block production. And behind Lido are investors, venture capital firms like A16Z, Andreessen Horowitz, Paradigm, and others who have poured billions into Ethereum-related projects. These VCs often push for upgrades and proposals that benefit their portfolios. They are deeply embedded in the Ethereum ecosystem, funding wallets, DeFi protocols, scaling solutions, and even governance tokens. Let's be honest, this isn't decentralization. It's a power structure, one shaped by money, influence, and back-channel relationships. Even Ethereum's governance is vulnerable to capture. Although changes to the protocol must go through Ethereum Improvement Proposals, EIPs. The people who write and approve those proposals are not elected by users. Core developers, often funded by grants or employed by influential projects, hold disproportionate sway. If you control the development talent, you control the protocol's evolution. And then there are the regulators, governments and agencies that don't need to understand the code to exert pressure. In 2022, when the US Treasury sanctioned Tornado Cash, it didn't go after Ethereum directly. It targeted developers, validators, and infrastructure providers. The message was clear. Decentralized doesn't mean immune. Since then, we've seen a rise in protocol compliance, from OFAC-compliant blocks to geo-fenced applications. Ethereum is adapting not just to technical constraints, but to legal and political realities. And the entities implementing those changes are not the anonymous cypherpunks of 2015. They are companies, funds, and stakeholders who operate under very real constraints. So what does this mean for Ethereum? It means the network is no longer just code on a blockchain. It is a political and economic arena, a battleground of incentives, ideologies, and influence. And while the ethos of decentralization still lives in the community, the actual levers of control are increasingly held by a small, interconnected group of actors. This isn't a conspiracy. It's how power works. When any system becomes valuable, especially one handling billions of dollars, it attracts those who seek to control it. Ethereum is no exception. It's now infrastructure for finance, identity, and communication. That makes it a strategic asset. And strategic assets are never left unattended. So ask yourself, when the next big protocol upgrade happens, who benefits? When validators censor transactions, who decides what's allowed? And when regulators come knocking, who gets protected and who gets sacrificed? Because Ethereum may still speak the language of decentralization. But the people shaping it today understand something far more familiar. Control is the most valuable token of all. Chapter 4. What's next for ETH? Innovation or institutional capture? Ethereum is now at a crossroads. On the one hand, it's more powerful than ever. Billions of dollars in value flow through its ecosystem daily. Layer 2 rollups are scaling the network. Major corporations are building on-chain. Real-world assets, from government bonds to real estate, are being tokenized on Ethereum. And Ethereum's roadmap promises even more: dank sharding, stateless clients, account abstraction, and more sustainable validator incentives. It looks like success. But beneath the surface, a deeper question looms. Is Ethereum evolving into a truly open global financial system, or is it slowly being domesticated, tamed by institutions, and turned into a tool of the very systems it once defied? Let's look at both sides. On the innovation front, Ethereum is still unmatched. Developers continue to experiment with new protocols and primitives, zero-knowledge proofs, risk-taking mechanisms, modular blockchains. Layer 2 solutions like Arbitrum, Optimism, and zk-Sync promise to bring Ethereum's capabilities to the masses, reducing fees and improving user experience. Vitalik Buterin and others have argued that Ethereum must be flexible to survive. In a world of regulatory crackdowns, user demand, and global competition, protocol pragmatism might be necessary. For example, implementing features that make compliance easier, like identity layers or censorship-resistant but traceable transactions, could help Ethereum scale without being banned or blacklisted. Proponents of this view argue that Ethereum is playing the long game: get mainstream adoption first, then decentralize further once the infrastructure is mature. They say that partial centralization in staking, governance, and infrastructure is temporary, a compromise to secure the network's future. But critics are not convinced. They warn that institutional capture is not a temporary bug, it's becoming a permanent feature. When custody of staked ETH is increasingly concentrated in centralized exchanges. When protocol upgrades are effectively determined by well-funded developers and DAOs with opaque voting structures, when front-end access to Ethereum-based apps is filtered by geolocation. Compliance layers, or App Store rules: how decentralized is the system, really? And the trend lines don't lie. Venture capital firms now dominate funding rounds for Ethereum-based projects. Liquid staking protocols are solidifying control over consensus. Regulatory frameworks in the US, Europe, and Asia are increasingly focused on making public blockchains fit within traditional financial law. That means KYC, whitelisting, and transaction surveillance, all of which are directly at odds with the cypherpunk ethos Ethereum was built on. it raises a critical issue for the ETH token itself. If Ethereum becomes a permissioned backbone for regulated finance, who will it serve? Will ETH still be a neutral, borderless digital asset? Or will it become something closer to digital oil, necessary to run compliant applications, but stripped of its ideological roots? There's also the risk of balkanization. As Ethereum adapts to meet different regulatory regimes, we could see fragmentation, one Ethereum for the compliant West, another for permissionless applications elsewhere, and multiple forks or layer 2s reflecting different ideological lines. This would undermine the very idea of a single, unified Ethereum. Meanwhile, competitors are circling. Blockchains like Solana, Avalanche, and even new generation Ethereum layer 2s are pushing alternative visions, some more decentralized, some less. And then there's the rise of app-specific blockchains, of modular chains that break Ethereum's monolithic model entirely. They offer scalability and customization, often without the governance baggage Ethereum now carries. So where does this leave Ethereum? That depends on who you believe will shape its future. If Ethereum remains open to grassroots development, continues to decentralize validator power, and resists the creeping control of regulators and corporate interests, it could still become the foundational layer of a new, freer internet. But if the current trajectory continues, toward validator centralization, governance capture, and regulatory alignment, Ethereum may simply become the new Wall Street backend, programmable, efficient, global, but no longer free. And that brings us to the biggest danger of all. Not that Ethereum will fail, but that it will succeed on someone else's terms. A future where Ethereum powers trillions in financial transactions, but users can't truly opt out. Where code still runs, but only after approval. Where decentralization is a checkbox in marketing decks, not a lived reality. It's not too late. The community can still push back. Developers can build alternatives. Validators can diversify. Users can choose projects that honor Ethereum's original values. But the window is closing, and the forces of capture are growing more coordinated, more institutional, and more permanent. So the real question is no longer technical. It's philosophical. What do we want Ethereum to be? Conclusion: Ethereum's identity crisis. Ethereum was once the rebel, born out of the ashes of 2008, promising a decentralized future where power would no longer be concentrated in banks, corporations, or governments. It gave us smart contracts, decentralized finance, and an ecosystem that challenged the very foundations of traditional power. But today, that rebel is wearing a suit. Ethereum is no longer just an experiment in distributed consensus, it's infrastructure for global finance. And with that evolution comes a profound identity crisis. Is Ethereum still a tool for liberation, or has it become a more efficient mechanism for control? We've seen the shift from decentralized miners to corporate validators, from anonymous devs to VC-funded foundations, from censorship resistance to transaction filtering, from cypherpunk dreams to regulatory compliance. Ethereum still works. It still innovates. And yes, it's still more open than most alternatives. But we must ask, who is it really working for now? Because decentralization isn't just a technical feature, it's a philosophy. A system cannot call itself decentralized if its consensus is driven by the few, its direction set by capital, and its compliance dictated by external powers. The real danger isn't that Ethereum will be shut down. It's that it will be absorbed. Silently. Gradually. Inevitably. But here's the truth, the future of Ethereum isn't fixed. It isn't sealed into code. It's still being written by developers, validators, investors, and you, the users. So if you believe Ethereum should remain a truly open, decentralized, and permissionless system, then it's time to act. Stake outside the major pools. Support public goods and indie developers. Question power, even when it hides behind decentralization. And above all, stay informed. Because the war for Ethereum's soul isn't over. It's just beginning. And the next chapter? That's up to us. If this episode gave you a new perspective, don't forget to like, share, and subscribe to Money Minded for more in-depth stories behind global finance and digital assets. Together, let's dig beneath the surface and uncover what really moves the money.